Welcome back to session 2. During the last hour or so, we went through some basic ideas on probability. Now it is time to explore some fundamental principle in finance. When the world is uncorrelated, basically when we have a large set of uncorrelated assets, it is possible just by making larger and larger portfolios to have or maintain a level of return while at the same time we diversify out the volatility. There are two theorems that explain how in this world of uncorrelated instruments it is possible to achieve such a fantastic result. One is known as the law of large numbers, which we have already looked at, and the second one is the central limit theorem. I will go briefly through this, just taking advantage of an interface. In section 3.2.1, we go in more detail describing what the central limit theorem is and to conduct some heuristic tests. The basic principle is that the average of draws of independent variables will tend to have a normal distribution. So, in principle, we will not only have lower volatility in diversified portfolios that have independent underlying securities, but also we will know about its distribution. The distribution of the returns of that portfolio will be normal. Let's look at this interface. What we have in this interface is essentially three menu boxes. We can start from an underlying distribution that is normal, an underlying distribution that is uniform, or an underlying distribution will be a student T distribution with 100 degrees of freedom. Notice that all these boxes are editable. So we can change, let's say, the size of the standard deviation or the variance of this normal distribution if we want. And we can also ask Maple to try different distributions. What we will have is an original distribution described by this red line. And then from this distribution, we will take samples. Each one of the samples will have a size that we can edit as well, and in this case will be 100. And then with each one of those samples, we take averages. And then we repeat the exercise different numbers of times, and then we take the distribution of the means. Then the number of means that we are going to look at can be controlled by this slider. So let's just start with an example where we will select a uniform distribution. Look at this. This red line shows a distribution, uniform, that goes from -3 to 3. Then we run 100 draws, and of each one of those 100 draws, we calculate the sample mean, and then we repeat this exercise, as we see here, about 130 times. Then the distribution that comes out is this blue distribution. And then we will draw a normal distribution that corresponds to the mean and standard deviation of this histogram. What we will notice is that a histogram really looks like this green line, which corresponds to a normal distribution. Let's play around a little bit with this. Okay, let's take, let's say, a smaller sample of means. The less number of samples we take, the distribution tends to look more like just simply concentrated around the mean value, but it really doesn't look that normal. It looks kind of uniform, to be very honest. But as we increase the size of our second sample, namely the number of means, then the distribution will look more and more like a normal distribution. We can try a quantile plot to see the deviations between the distribution that comes from our sampling exercise and the theoretical distribution of the quantiles for a normal. So we see a very, very small deviation. That deviation is bigger the smaller our sample is, as we should expect. Look at this. This looks messy. But as we increase the number of draws, then the distribution will tend to be normal. Then down here, we can just run a chi-square test for the suitable probability model using as the null hypothesis a probability distribution that it's a normal. We will need to click here to calculate, and just let's go down a little bit, and we will see that for the last exercise we run, there is no statistical evidence against the null hypothesis of a normal distribution. So, success. What we have seen here is that we can start from a uniform distribution, then take a large number of draws, in this case 100, we can take more, then we calculate the averages, and then we distribute of the averages of exercises repeated for, in this case, about 250 times. The result will be a normal distribution, and this will prove, at least heuristically, our central limit theorem. We can do the same with different original distribution. Look here. I mean, I'm starting with a normal. I'm starting here with a chi-square. I can reduce, if I want, the number of degrees of freedom. Let's have 5, which will make it more awkward looking. But again, we will tend to normality. And here's the quantile plot. And let's just calculate again our chi-square test, and we will see again that there is no statistical evidence against the null hypothesis. Well, thank you very much, and we'll see you around for session number 3.